Welcome, everyone. I hope you're all having a great Tuesday. Thank you so much for taking the time to join today's webinar. We'll go ahead and talk about using self-directed IRA funds to invest in senior living facilities. It is top of the hour, and I do want to be respectful of your time, so let's just go ahead and get started. I'm Reneika Lightbourne with Advanta IRA, and I'm really excited today to be joined by Conner Girdley. He's from Purity Strategies. He's an expert in senior living investment banking and also the healthcare space with over a decade in experience. Welcome, Conner. Thank you so much for being our featured speaker today.
Oh, thank you, Reneika. Really great to be on. Looking forward to sharing some thoughts and the conversation that follows.
Yeah, absolutely. Conner is going to kind of give us a better understanding of the increasing demand specifically as it relates to senior living investments, and also how to be able to identify and evaluate profitable opportunities. Before I turn it over, I just want to give you a general synopsis of what self-direction is and how it works, and of course, when you're ready to get started with your account opening, how we at Advanta can help you with that. If you have questions, go ahead and put those in the question box. We'll actually hold those until the very end. We'll get every question answered, but again, it's going to be at the end of Conner's presentation. So again, my name is Reneika Lightbourne. I'm one of the business development specialists here at Advanta IRA. I've been with Advanta as an employee since 2019, but I'm also an Advanta IRA client prior to joining staff. So self-direction is something that I actively do. So this is something I strongly advocate both personally and professionally. If you have questions or you want to kind of talk through your exact scenario, you're always welcome to give me a call or send me an email, or of course, visit our website at advantaira.com to schedule a consultation. Just a general reminder and housekeeping that at Advanta, we don't give any tax, legal, or investment advice. All of the information that's going to be presented today is just for educational purposes. As always, we encourage you to do your due diligence, consult with your professional team before making any investments. If this is a new concept for you, just some quick takeaways. Just know that any IRA or former employer plan, like an old 401k, qualifies to be self-directed. Two, the beauty of self-direction is you're in control. You get to decide what is it that you want to invest in. Today, we're focusing specifically on senior living facilities. And then, of course, thirdly, just knowing that all of the income generated from that investment goes back into your retirement account. If there's any related expenses, it's paid from the retirement account. So just a little history about Advanta and who we are. We've been in business for about 21 plus years now as the leading self-directed IRA administrator. Our headquarters is in the Clearwater, Tampa Bay area, but Advanta has an office in Atlanta, which is where I'm based. We work with clients nationwide as we have well over $3 billion under administration. Our focus here at Advanta is providing you, our clients, that concierge style service where you have an assigned account manager who's with you for the life of your account. We also have great educational content, different topics, which includes having experts like Conner come in and knowledge share with you. This webinar is recorded. It's going to be uploaded onto our YouTube channel and also our website, our on-demand video library later today or first thing tomorrow. You're always, again, welcome to check out our events. We encourage you to listen to our podcast. My colleague Alex Perney hosts that. You're always welcome to check out our blogs. Anything and everything related to self-directed IRA, we have you covered. So just really quickly in terms of what is self-direction, in terms of just knowing that you as the account owner, you're going to have complete control over your retirement funds. You have complete control over the investment decisions. Our clients use IRA funds to invest in a long list of different things, which includes real estate, it includes multifamily, it includes precious metals, oil and gas. The list goes on and on in terms of what's on the table for you. Today, we're focusing specifically, within a space within real estate, meaning senior living facilities, almost like, private equity. But just know that you have the ability to invest in many different things with your retirement account. So why do people choose to self-direct? You may look to self-direct for many different reasons. I'll just touch on 3 of them. One, it's a new source of capital for you. So instead of taking money out of your savings accounts or taking out a bank loan, if you have funds in an existing IRA, or again, if you left in an old job and you have that TSP or that old 401k just sitting idle, you can elect to move some of those funds to make your next investment. Another reason as to why someone may look to self-direct is because of the stock market, the ups and downs, the volatility with the stock market. Whereas with real estate, we know with senior living, obviously the underlying asset is property, is tangible real estate. So it gives you the ability to diversify your account. And then the tax benefits, knowing that the income that's generated from that investment flows back into your IRA, tax-free or tax-deferred, depending on the type of account that you have. In terms of the different types of accounts that can be self-directed, again, the term self-directed just means that you get to decide what is it that you want to invest in. The account types are, if you go to the IRS website, you'll see for individuals, you have traditional IRAs, which is pre-tax, meaning you get the tax break up front. You pay taxes at the end when you take it out during retirement. Whereas with a Roth IRA, those distributions will be tax-free as long as you've held that account for 5 years. And also, once you reach retirement age of 59 and a half, simply because with the Roth IRA, you're paying taxes up front. If you're self-employed, you have a side business, or you're an entrepreneur, you have flexibility with self-directing either a SEP, simple, or solo 401k. A lot of real estate professionals prefer the solo 401k just because you do have greater flexibility, you have higher contribution limits. If you want to talk more about that, again, you're welcome to always reach out to us. Some lesser accounts that are just as important in terms of having the ability to self-direct is educational savings accounts. So if you have, kids or grandkids, you can certainly look to put money in an ESA to cover their educational expenses. And then, of course, the cost to cover medical-related expenses. As long as you have a high deductible insurance plan, you have the ability to self-direct. So you do want to consult with your plan provider to see if you're eligible based on the type of plan you have. And then again, any former employer plan, whether it's an old 401k or 403b or a 457 or TSP type plan, those can be self-directed. The only thing that you need to be mindful of is if it's a current employer plan and you're not yet 59 and a half, which is the IRS retirement age, then most times the employer will restrict you from moving it because, again, it's a current employer. You can certainly inquire to see if they'll make an exception to allow you to move a portion of it. But don't be alarmed if it's current employer and you're not 59 and a half and they tell you no, that's just more so than following the IRS guidelines. If it's an old job, you can move it at will. There's no issues there. In terms of funding your account, you have several different ways. In addition to making a contribution, which I'll touch on the numbers shortly, you have the ability to transfer as much or as little as you want to or need to from an existing IRA. So let's just say you have an IRA at a brokerage firm like the Fidelities or Charles Schwab of the world. You can move as much or as little as you need to make that investment. If you have an old employer plan like a 401k, again, you can move those funds. You would actually have to initiate that process. I will guide you through it. If it's an IRA, Advanta will work with the other custodian on your behalf to get those funds moved over. If it's an old employer plan, then you have to more so reach out to them to tell them you want to move those funds. Taking a personal distribution, it's coming over to another qualified retirement account. The other way that you can also fund your account is by making an annual cash contribution as long as you have earned income. If you are looking to make a contribution to a traditional or Roth IRA for 2024, if you're under the age of 50, you can put in $7,000. If you're over the age of 50, you have an additional $1,000 catch-up. For SEP IRAs or solo 401ks, for SEP IRAs specifically, you can contribute up to 25% of your earned income, not to exceed $69,000. Same thing with a solo 401k. If you're under the age of 50, you can contribute possibly up to $69,000. The thing is with a solo 401k, essentially, you're contributing as an employee, but you're also matching up to 25% of your employer. So when you combine the two, you have those high contribution limits. For an ESA, again, to cover educational expenses, you can contribute $2,000 per year per child. And then with an HSA still for 2024, you can put in for individual plan, as long as you have a high deductible, you can put in $4,150. If it's a family plan, you can put in $8,300. And of course, if you're over the age of 55 with an HSA, specifically, you can put in an additional $1,000. If you're ready to get started, or in the future, if you decide to revisit self-direction, the process with us is actually pretty straightforward. You can go directly to our website at advantaira.com, fill out the application in terms of clicking on the link to open the account. We'll get your account open pretty quickly, typically within 24 business hours. The application process, is relatively quick as well. If it's an employer sponsored plan like a solo 401k, then of course we would have to do a little bit more hand holding in that regard. Once your account is open, you do have an assigned account manager. Again, they'll be with you for the life of the account. So that's step one, getting the account open. Step two is funding, whether that's a combination of making annual cash contribution as long as you have earned income, transferring from an existing IRA, or doing a direct rollover from an old employer plan. And then finally, start investing. What is it that you're interested in? Is it something that Connor's going to say on today's call, or you're specifically looking at senior living facility properties, or you're looking at, investing as an LP, or you're looking to invest in other alternative assets? And with that, I'll go ahead and turn it over to Connor. So just bear with me. Let me make him the presenter.
All right. Well, thank you so much for that intro. Lots of interesting ways to invest. And, I thought I would take a moment, go back in time a little bit before we start. Back to the year 1935. That's the year Social Security was put into place in the US. The average life expectancy at the time was 63 years old. So now if you flash forward to today, average life expectancy is 76 years old. So, what does that tell us? Well, it tells us that people are living longer, they're living healthier, and they're living more meaningful lives. And kind of there's an expectation that's going to continue to happen going forward. So, broadly speaking, that's what kind of drove me to get interested in senior living. And I think it's an asset class that has a lot of room for growth potential going forward. And I wanted to share with you kind of some thoughts today around what investing in the space looks like, and leave you with an impression that, how do I invest, and what should I be looking for when it comes to opportunities. So I am Conner Girdley. I'm founder owner of Purity Strategies, and let's get into it. So here's kind of 4 thoughts I really wanted to hit on. So what exactly is senior living? Can we go in at a more granular level and talk about different acuities, different structures? What kind of facility is it? And then second, why should I invest in it? Why now? I think it's a great opportunity. There's a lot of tailwinds in the industry. COVID also played a very large role in the start of 2020 and where we are today in the cycle. And I'll build that business case for you, something that really attracted me to invest in the space, bring additional people into the space to invest. And then, I'll talk about some considerations when you're looking at investing in properties, specifically for senior living. Things like, what should you look in for the operator? What questions should you ask when you're looking at a pro forma? What's your investment horizon? What does the cash flow look like? So all those kind of important topics you want to know when investing. And then finally, I'll leave you with how to invest. I think there's many ways to invest, and some have better risk-adjusted returns, in my opinion. And we'll kind of walk you through some of those high level and leave you there. All right, so high level senior living. It's at the end of the day, it's real estate. So real estate's pretty simple. You have cash flow and you have a cap rate. And the more cash flow you have, the better the asset quality, the lower the cap rate, the more the asset's worth, right? Well, with senior living, there's also this operational component to it. And so that drives a lot of that cash flow. But as you're looking through this, don't overcomplicate it. At the end of the day, it's cash flow. Cash is king when it comes to real estate. It's no different here. So in terms of product offerings for senior living, there's been a burgeoning of this asset class, the 55 plus age restricted type communities. These are primarily for sale communities. Think like a Del Webb, if you've seen that. Communities that are primarily for sale. I'm really not going to cover too much of this piece right here. I'm getting more focused on the independent living, assisted living, and memory care. And so independent living is for more active seniors, seniors who don't have, the health issues that you might see in assisted living, memory care. And there are generally services that are offered, things like meals once or twice a day. It's optional. And then additionally, you'll have access to more amenities than you would in assisted living memory care environment. I call these a la carte services, right? So assisted living, that's where a resident has need for daily care. It might not be all the time. They might only need some help with bathing, with eating, those kind of primary functions, getting dressed. Maybe they just need more activity than they're able to get at home. So that's assisted living. It has a pretty wide range of individuals in terms of acuity and levels of care associated with it. But then you have memory care, which is more or less round-the-clock care. You can be in different stages of dementia in memory care, but more or less, you need round-the-clock care, and you need to be at a place where they spend a lot of time, with those residents, keep them engaged, because all the studies have shown that the more engaged someone is with memory care, the slower that Alzheimer's process develops. So they end up living more healthy, longer lives. So that's very important on the memory care side. So those, assisted living memory care, they have this notion of levels of care generally, or all inclusive. Assisted living, you might have a cost per month that's $350 to $1,000 a month for that different varying levels of care and how much activities of daily living you need to get through the day. Memory care is generally all inclusive. You might have an additional level of memory care, but once you're in memory care, you need round-the-clock care. So there's not much differentiation there. And then kind of this last category, which does fall in the senior living bucket, is skilled nursing. I'm not going to talk much about that today. It's really a separate kind of asset class, in my opinion. You have kind of independent assisted living memory care is one, and then you have skilled nursing, it's separate, and it's one step away from the hospital. So we hit a little bit on the types of communities. For sale, I think this does have a place, but I'm really not focused on investing in that space right now. I'm more interested in the rental space, just because the recurring cash flow is very strong. It also supports a really nice institutional product. And I think for the for sale product, obviously you have to be a developer, you're building new communities, new construction. And right now where we are in the cycle, acquisition is it's doing so well relative to new construction, just because basis and replacement cost is so high for new construction relative to the existing product out there. And I'll talk you through some of those data points. Kind of the last type of community, the continuing care retirement community. I'm not going to hit much on these. These are typically nonprofits, and they're more like country clubs, and they have entrance fees that can range from a couple $100,000 a year to places like Lynbrook in Atlanta, where you might have $1 million entry fee, in addition to paying a monthly fee for your varying types of service. And they generally carry independent assisted memory care, skilled nursing. The reason I don't really focus on these is because most of them are non-for-profit. It's harder to invest. Definitely on the equity side, it's impossible, but really your only avenue to invest in those are tax-exempt bonds, which is a viable investment strategy. But I'm more focused on the equity stack in this call. So I just wanted to highlight different types of product when we're looking at things and what the rental rates are per month. So something like this, where it's kind of squarely middle market, it's built within the last 20 years or so. You're looking at rents anywhere from $3,500 a month for assisted living, starting there, to memory care starting at $6,000, maybe going to $7,000, maybe $8,000 in some markets. And then you have something that's built, within the last 5 years or so. It's a middle market product, but it really tailors to upper middle. So it has, nicer finishes, bigger rooms, better common areas. Those might start $4,500 a month. and go to 6,000, 6,500 on the assisted living side, and we could go as high as 8,000, 8,500 a month for memory care services. And kind of the last category, luxury, right, super high end, where you have kind of independent assisted and memory care all in one asset or one campus. They also have lots of amenities and things like valet and for people coming to visit mostly. So those might start at 8,000 a month and go to 20,000 a month. So there's it's kind of a big spread, right, between different types of assets and the rents they can receive, and that really changes dramatically the investment profile, right? And so you want to take into consideration, if you're interested in investing in the space, kind of what product are you interested in investing in, and then does your thesis that there's a reason to invest in these products, does that thesis fit the pro forma and the growth and the expectations of returns going forward? The last one, Lynbrook CCRC, really big, nice campus. Includes independent assisted memory care, skilled nursing. Being a CCRC, hard to invest in, but it is something to take into account because they could be a competitor, especially if you're in the luxury high end. You're competing directly with these folks, so you need to know and understand their business model to some degree to feel confident about investing in something like this, and being able to look at the market and try to digest that. So I think this is a really interesting slide, and I think it kind of makes the business case for investing in senior living compared to other multifamily asset classes. And it's something a lot of folks looked at pre-COVID specifically. Pre-COVID, these returns, were above 12% over a long time frame, right? And that includes the great financial crisis. So relative to apartments, hotels, other types of multifamily product, senior living has had elevated returns, and it's got a lot of people interested in investing in this space, for the last 10 years or so, and they've seen the returns. So I think part of this is that senior living has been proven to be a good defensive investment in times of economic distress. A lot of these senior living properties, they're needs driven. So if you need help bathing, getting dressed, I mean, there's not a lot of options for that, right? You can get that at home, and in some cases through home health, but that gets very expensive too. And so, institutional setting for that can be very beneficial to not only the family, but also the potential resident. And, if it's needs driven, it doesn't really matter what the market is. Those people are going to need those services, especially things like memory care, right? But I think these numbers, they're elevated returns versus kind of your apartment type deals. So I think it's slightly misleading to folks who haven't been in the industry a long time, because there is this operational component. And so if you're going from the multifamily side and you're looking to build senior living, you might not have factored in the associated risk with the operational component, and you might just be looking at the returns. And I think that's a poor way to look at it. But I think if you're partnered with the right operator, or you yourself have been operating senior living for a long time, grow up, you're an executive director in a facility, and you know how it works, right? And then you're going out and you're looking to build or buy facilities. I think this investment piece right here, it's a very strong business case to be made versus investing in other asset classes. And like Reneika said, I mean, it's a niche. It's a niche within a niche. So, if you pair up with the right partners, I think it's a fantastic investment, and I do think it will exceed and continue to exceed other multifamily assets just because of that reason. So here's kind of some things that have been going on recently in the industry, and some of these challenges, right? I think the first one has been labor, right? We've had a lot of inflation, and we've had competition from other providers. So, you know, the alternative of a care worker going to work at Walmart or a retailer or being a cashier and being paid a similar amount as they're in a facility dealing with, you know, people that have trouble clothing themselves. You know, they might need help moving around. It's a much more challenging, demanding job to work as a care worker in an assisted living facility or memory care than it is to go work at Walmart. And so there's a trade-off that everyone makes, and you know, as such, the cost of labor at Walmart and what they're willing to pay per hour, it puts pressure on senior living because they have to at least match that, right? Or they're going to lose people. I think good culture can help retention on the employee side, but only to a certain degree. And it's really not fair to the worker to make less than, you know, they can work at Walmart or being a cashier. So large increases in labor costs have put pressure on margins, and it's really changed the way you have to underwrite a deal since COVID, and we have that bout of inflation. Now, second point, COVID fallout. So during COVID, you know, senior living facilities were hit very hard, and it was twofold really. So you had a lot of residents got sick from COVID, and you had attrition there, so occupancies went down. Secondly, you had people very hesitant to move mom or dad into one of these facilities where they could contract COVID and get sick and be in a similar situation themselves. So they decided to stay at home, which, you know, of course, puts pressure on the family. It makes things more challenging, but at least mom and dad are safe. And so, you know, industry's still recovering from that, but I think it's made incredible strides. And I'll show you on the next slide, or maybe the one after that. Occupancies are improving very quickly, and the senior living has been recovering very well, at least recently. So the last two, they really go together. Rate pressure, right? So as a developer or sponsor, right? For real estate, it's a levered. It's almost always levered. So you're always getting debt because other real asset has less risk than a typical just regular run-of-the-mill business. Real assets there, and so you need to lever them to get a return, and the seller knows that. So, you know, that asset has real wealth to it. And so, you know, if you budgeted 5% for interest rates going forward, and all of a sudden, you know, right now today, you know, the pricing is 9 to 10%. So it's double what it was. If your debt has gone and doubled, you know, your returns to investors are much lower, if they're there at all. There's a lot of situations where loans are upside down because of that. And, you know, pre-COVID, we were seeing really high price per unit on these sales for senior living facilities. So people were paying kind of top end of the range, and then they were stretching to get that done. And then interest rates doubled, which has created kind of a perfect storm when you add in COVID and reduced occupancy and the labor challenges that occurred. So, and I think we hit kind of both of these at the same time. So here's kind of part of the business case, right? And you know, I like to do a lot of historical analysis to really determine, you know, is this a good investment? Does the story make sense? And it's not only when it comes to certain asset, but the industry as a whole. I think if you're investing in an industry that has really good tailwinds and a really good business case, that can overcome some issues you might have with an individual asset. If it's the other way around, it makes it much more challenging. I think you got to spend a lot more time underwriting and being very selective of opportunities. So, you know, going back to like 2015, you had occupancy that were turning around 90%, which is kind of the long-term rate for senior living. You want an asset to be around 90% and consider that stabilized, right? So that's about as good as it gets, because you're going to have attrition in a facility. It's going to happen. You have to replace residents. You're going to have to turn rooms. There's going to be some delta in your max, your 100% occupancy and where you're currently at. So 90%, it's generally where I underwrite most deals. So going back to 2015, you really had this growth imbalance. You had a lot of folks who are looking at the returns in senior living compared to other multifamily asset classes and saying, wow, that's pretty impressive. I want to get involved with that. I bet I can raise money to go build senior living products. I can build apartments. Let me go, I'm sure I can go build senior living products. And see a lot of people entering the space. You had a lot of money going after and stretching on deals. You had historically low interest rates. You had a lot of things, right? And that created this growth imbalance where you had more supply, and that's this blue bars, right? You had more supply on an annual basis, right? It's actually quarterly, compared to absorption, right? So supply was kind of stripping demand. And so naturally, you had occupancies going down during that time frame. Well, this probably would have corrected itself eventually if left untreated. However, COVID hit, and you can see this really big drop. This black line is occupancies for the industry that occurred. So you had a huge drop, and then it lasted for about a year, all the way down to 78, a little above 77%, and the industry as a whole. So that means there's a lot of product out there that's well below stabilized, and probably not able to cover their debt, especially at the increased debt levels. So what's happened since 2021 has been just this great recovery, because all these banks who had these loans with senior living providers, they're really not interested in going out and funding new construction deals. So you've had the opposite case where absorption rates have really outstripped supply in a meaningful amount every single quarter. There are still very limited new construction projects going on. And I'll talk a little bit about some other tailwinds in the industry, but this has a big impact for the investment case. I'm of the opinion that, we're at 86% right now. I'm of the opinion we're going to overcorrect. I think we'll continue on this upward trend, and we'll surpass 90, and we'll end up, kind of low mid 90s. And we'll have that as a trend rate going forward for a period of a couple of years. And then, this will spur kind of this growth imbalance restart, right? More people building new projects, seeing the returns coming back into the space. But that's going to take time. I mean, it takes 18 months to build a senior living facility, 2 years if it's sizable. So we have a lot of runway, I think, in this market, and I'm pretty excited about it. So here's a really strong tailwind that's going on, right? And I kind of hit on it a little bit early in the presentation, but people are living longer, and we also have a population that's increasing. And so if you look at 1980, we had a much smaller, and it's really these top bars. So senior living is really focused at 75 plus age category. But we've just seen this dramatic increase to today, right? This chart's getting thicker up top. And then by 2040, right, population's expected to double for 75 plus. And so, if we're going back looking at this, we're saying, okay, we have demand outstripping supply. We're not building anything new. Well, if that was in a vacuum, that would still be a strong business case. But we're expected to double the amount of need over the next 20 years. So I think those two factors are just really strong tailwinds to support business cases investment in space. Just really high level on interest rates. We're at peak interest rates on the short end of the curve, and have been since the Fed started raising rates, at least through the last 20 years. And expectations are these rates are going to come down. Whether they go down from the current 525, 533, if you look at SOFR, all the way down to 3% over the next 3 years, I don't know. But I'm of the opinion they will go down at some point. And just generally, broadly speaking, owning real estate in declining interest rate environments provides support for cap rates, and it makes transactions easier to get done because REITs and the big buyers, they really focus on what kind of spread they can get from what their borrowing costs are versus what they're able to buy the product at and get a return on that capital. So I think generally that's just another tailwind for investment in real estate. So let's talk a little more specifically about looking at projects and evaluating senior living projects. So I really, I've been focused on distressed and value add opportunities. And I like to start that analysis with partnership. So I'm a capital provider. I don't operate, I don't manage the facilities. And, you know, in the multifamily space, it's very common to just have a management agreement. So a manager will come in and manage the asset for you for a flat rate, you know, 3 to 5%. In senior living, and especially when you're talking about a distressed or value add opportunity where you want to turn an asset around, you know, one that's not making money to making money, or maybe improve upon the current census in the building, take occupancy from 80% to 90% and have a marketing strategy around that. I think it's really important if you're a capital provider to form a joint venture with an operator and give them significant upside if they do their job well, and also have them invested in the deal. So I think both the general partner, sponsor, operator, they should be investing in the deal alongside each other and create a joint venture. I think that's the most healthiest way to align interests and give the project the best chance of, you know, returning capital plus proceeds to investors. So when it comes to that, experience is key, right? I mean, so if you're evaluating a project and you're looking at who the operator is, well, what is their track record? I mean, have they operated similar buildings? Are you looking at buying an assisted living memory care, or does it have independent living cottages around it? Is it memory care only? I mean, and how have they performed? How did they perform through COVID? How are they performing today? Understanding their entire track record, right? So you don't want to just hear about the wins. You want to hear about the losses too, because no one's perfect, right? And almost every operator out there has had some issues in the past. But being able to articulate that and understand why that failed and why it won't fail in this case, I think it's super important. So doing the underwriting and having a focus on that, asking that question if your sponsor isn't really, you know, hasn't shared that information or hasn't been specific with it. I think the experience piece is very important. Market's huge, right? Doing the work on the market, understanding where occupancies are, you know, is there any new construction product coming on? What's the case to be made that this asset is going to turn around when it hasn't in the last 2 years? Maybe it's been owned for the last 10 years and it's never done well. Maybe it just hit a blip during COVID, was doing fantastic before COVID, but you know, took the blip down, and then the business that grew pre-COVID, it's now struggling, and there's an opportunity in there to pick out certain assets and certain markets that you know, the operator that's partnered with the sponsor thinks they're going to do fantastic. What does the demographics look like? So, you know, I'm based out of Atlanta, right? We have extremely strong demographic growth, tons of people moving into Atlanta. We have 20 to 30% plus in 5-year growth rate for the target seniors market here in northern Atlanta, or in the northern Atlanta kind of rim. But there's also a ton of product there. So, you know, you got to be careful with what markets you invest in. Some are, in my opinion, over vetted. They have too much product. Others, I think, are you know, they'll be killing it. They'll be crushing it in 2 or 3 years because there is no new construction going on. So really understand that market piece, very important. Asset type, right? I talked a little bit about this early in the presentation, but you really want to match up and marry the pro forma and the expectations around rate and growth versus the type of care provided. Additionally, having third parties involved to perform their own due diligence at that, for the real estate, major movables, HVAC systems, all that stuff, very important. You want to make sure you check all the boxes and deal with any kind of environmental issues that come up, and do that on, as soon as you can on the front end. I think having a great deal team to kind of drive a lot of that and identify issues, I think that's super important when it comes to real estate, because these transactions take at least 6 months to get done, and there's a lot that happens in the process. So the more you can stay in front of these issues and negotiate those up front, the better off the you will be as a sponsor or investor in the project. Cycle, I think this is a buyer's market right now. It's a really fantastic market. You can buy stuff at a fraction of replacement cost, anywhere from 30 to 50% of replacement cost. And I'm talking, newer, nicer product, older product that's at a really good basis, that has cash flow. So I will caveat that in that it's really tough to obtain debt. So the lender who did the deal originally, they're probably underwater if they're selling it at that basis, or they've been dealing with forbearance agreements on this property since COVID. So they're probably not going to want to continue with the asset. So you need to go find a new lender, and that sponsor, that operator, they need to have those relationships in the bag, or they're not going to be able to deliver what they said they would to the seller in terms of purchase price if they're unable to lever the asset properly. So I think doing that diligence on that sponsor group, really understanding where their capital is coming from, and making sure that they have plenty of access to it and they can deliver when they need to. I think that's another key piece, especially in this market. All right, I want to talk a little bit about organizational structure, just because real estate in general, I think a lot of multifamily deals look similar to this, with the exception that there's this operations piece, and for senior living, there is risk of litigation, right? If someone has an incident in your facility, so you want to try to protect yourself as much as you can. And the way we really do this is we'll set up an opco, so an operating company, and a propco, property company. The operating company owns the license. These are licensed facilities by the state in almost all cases, unless you go down to independent living only. Some states, no licenses there. Then the property company actually owns the real estate. They own the actual real estate. And so if you separate those two, it kind of limits the ability of litigation moving from here to here. And that's really what you're trying to do with this structure, is kind of limit how much access to the actual real estate is involved in case there is litigation at the operator level. So the operating company, has the employees, hires the employees, has the license, and then generally there's a management agreement between the operating company and the manager, who in my deals would be the same company, right? Because I like doing joint ventures, and you can see it up here. But it kind of flows through that way, and then we generally put some holdcos in between us and the operating company, just to further that legal liability. And you can see kind of here GP equity. So this would be me in this instance, forming a joint venture with the total general partnership with the operator over here. What does that split look like? Is it 70-30? Is it 50-50? I think you can have a lot of success at different levels, and especially when the operator's investing heavily into the deal. But I think this number should be around at least 30%, in my opinion. If you go less than that, then you want this operator to do a great job. You want them to turn around the building quickly. It makes everyone's lives easier. Incentivize them, give them a larger share of the deal. That's kind of my opinion. And so, for folks on the call, right, LP investors, right, they would come in with their capital here through a fund set up by the GP sponsor, and combined through the partnership with the operator, they would invest in the holdco, which would have the operations. And there are differences here. Sometimes the LP investors stay only on the property side. It's really state specific and how that's structured. But they're going to get access to the holding company, which holds the property company, by their 100% common member through this senior living fund. And so, at the end of the day, LP investors do own the real estate, which is really the focus, right? As an equity holder. Another piece that's pretty common is either a preferred equity member or a mezzanine debt provider. I'm pretty positive about these in the current market. I think being able to lever a project correctly, especially where there's an outstanding potential for low basis and filling up a building quickly with a great operator, I think that really bodes well for LP investors. It adds leverage, which is always a concern. But really, the cost of preferred equity or mezzanine debt, 10 to 15%, versus your mortgage lender straight loan at 9 to 10%. The delta is not much now. It used to be much more. So I think evaluating these preferred type structures and mezzanine debt structures really helpful in the current market. And of course, the mortgage lender, they would have a first lien on the properties, and the opco passes through lease revenue to the propco, which pays the mortgage lender. All right, I think looking at opportunity in the current market, historically, targeting 20% annual IRR, 2x multiple. I think that applies here for senior living. I will say in this current market, I think there's a runway of 2 to 3 years, maybe still, where you can buy properties at a very low basis that don't have a huge additional risk profile relative to in normal markets. I think targeting 25 to 30%, maybe more than 30%. I think it's totally achievable as an LP member. And I think the multiple, being higher 2.5 to 3 times even, I think that's very achievable over the next couple of years. I would target a 3-year hold for almost all deals. It's the life cycle of real estate. It takes a long time to get things done, get the refinance done, get the sale done. I think a 5-year hold is probably appropriate on most transactions. Deals I'm targeting, I think you should be at least break even from operating. I think that's very important. It makes it easier to get a loan from a lender, and it also makes it to where you don't have to fund losses or put up a big working capital fund to make the deal work. I think the trade-off of getting a little lower basis because the asset's doing really bad versus buying something that's doing okay and turning it into great, I think the trade-off's not that great. So I think going after stuff that's doing okay is pretty good in this market. We have all kinds of way these transactions come in, way sponsors get notified. Obviously, you have the brokered channels, right? I really like limit offerings right now. These deals as turnarounds, they take a lot more time to evaluate. Spend a lot of time in the market, a lot of time with your operating partner, putting together a really meaningful pro forma. And if your hit rate's very low because you're chasing after widely brokered deals, I don't think that's the best time spent in a lot of instances. So going after limited offerings or maybe seller-focused offerings, I think that's really great. Loan assumptions, these two, it's more limited, but they do happen. This can be fantastic if you can just acquire a loan and not have to worry about going and raising the financing yourself. Limited applications for these types of deals. And receivership sales, these can be great deals, but you got to put up a ton of capital as a sponsor. So the sponsor just has to be very well off from a capital perspective and have a lot of dry powder ready to go. And these can be messy too because of the receivership process. I've seen them go quickly, but I've also seen them take years to get done. So I think most deals come from this channel, but obviously it's worth spending some time looking at these if an opportunity comes up. All right, just real quickly, I wanted to show kind of the flow on an investment. This just have some example numbers in here, right? Funds come in from LP, GP, day one at closing. There's generally some kind of financing reserve for these because while they might be cash flow positive, they can't pay the debt service, right? And so, use some of these funds to help pay that. And then, you'll have your first year, you'll have some cash flow, maybe not enough to pay the loan. And, in this case, just acquisition loan and mezz debt was the assumption. And so, you have slightly negative cash flow, you use some of the financing reserves. Year two, you're doing much better now. You're filling up the building, you're pushing rents. You might be in a situation where you can do a release or maybe some kind of earn out and return that money to investors. There's like the earn out here, right? And this just the balance of reserves. So use that proceeds. You can pay down. You can pay the interest rate current, and then maybe pays down some of the mezz debt, right? You might not be able to pay investors, LP investors back, but pay down some mezz debt. Year three, this is always where I structure a refinance of some sort. So taking out that acquisition loan, putting in a mini perm, so it's just another privately placed loan. Or at that point you could go and get a permanent loan, whether it's HUD, agency, private lender. That's an option too. But the expectation that you'll get a ton of cash out and go to agency, it's challenging right now. So I think you're probably doing some kind of mini perm structure in the third year. And this is generally where I see investors, LP investors, get their capital returned to them. They might not get a lot of return on that, but they get the capital back. Year four, right? You got a lower debt balance. You're paying less interest than you were. You're not paying $1 million. You're paying $850. So that's additional cash flow to investors, right? In the whole pool. So that's when you start getting your nice cash flow return on your investment. In year five, you kind of built in your sale, right? You're stabilized at this point. Do you sell in year five? Maybe, maybe not. You want to consider what's the capital market look like? Am I getting a good cap rate on my investment? Do we like the cash flow going forward? Are we comfortable with, $783,000 on a $2 million investment, right? That's great cash on cash return. So, just things to consider. You don't have to sell in year five, but that's generally how we structure these deals for the 5-year exit. And at the end of the day, right, you get these calculations down here. IRR, it's an annualized figure, right? You would take your investment, and then what's kind of the 5-year discount rate to get back to this amount, and that's 45%. But you can see it's not an annual. It's a very chunky type structure, right? You have big cash flow occurring in different years, right? So it's pretty chunky. Oh, sorry, down here. So it's less in the first couple of years, nothing in year one actually, and then it kind of ramps up, right? And then this is kind of your go forward cash rate, and then this is your exit. And then the cash multiple, just simply dividing the sum of these over this, and that's your kind of your cash on cash multiple on your investment. So got 5-6 minutes left. I won't spend a lot of time on this, but there's a lot of different avenues to invest, right? Probably familiar with public trade securities, private placements. The only consideration I would make here is, are you getting a straight common equity investment, or is there kind of some preferred return to it, anywhere from 8 to 15%? That's where I see a lot of preferred deals done. And then what's your waterfall, right? How much does the sponsor get for his performance relative to the capital they put in? Is it a 20-80, and at 10% it goes to 50-50, and then there's another waterfall, or is it just a simple structure where it's you split 50-50 after your preferred is paid back? There's a lot of structures there, but things to consider with this waterfall piece. The ways to invest taxable versus self-directed IRA. Yeah, you got to talk to your accountant about those pieces. Every investor is very different. Taxable, the benefit is you do get depreciation, which can be substantial on these assets. Investors can't always get access to this depreciation, at least early on. And so, you may like to invest through a self-directed IRA. I have investors that invest in either of these categories, and it's just because one fits where they're at financially better than the other. So really, take the time, sit down with your CPA, and if it costs you a little money to figure out a good plan on how to invest, I would recommend that. That would be my approach, and that's how I approach my investments as well. So Reneika, I know I talked for a while. I can kind of pause here and see if there are any questions.
Wonderful. Yes. Thank you so much, Conner. Great information, a lot to digest, but obviously you kind of outline, the great opportunity within the senior living facility space. I do have some questions, and again, we want to, be respectful of everyone's time, but we also want to get some questions answered. So a couple questions is, in slide 3, you reference 8.02% yield. Is that the net of fees?
So I would look at these on a relative basis. This is a large index, and doesn't include fees. I'm not sure. I could look it up for you, but you shouldn't expect an 8% return on a real estate investment, right? I mean, if you're investing on a private basis, these are more like big public type structures where they do a lot of the work for you. Maybe you just invest through an ETF, or maybe an owner operator or a basket of them. So I think when it comes to this comparison to private investment, it's more so to just show how senior living has outperformed other asset classes than to really be like, okay, this is the number you should target. I guess that's how I would approach it. I'm happy to look up and see if it includes fees or not, though.
Okay, next question is, does one need to be an accredited investor to invest with you? Like, how do you work with self-directed clients? I know you mentioned it, but question is, does one need to be an accredited investor for this investment?
So for my deals, I have been only targeting accredited investors. That being said, I do have funds I work with who work with investors that are much smaller and have smaller check sizes, and they invest with me through their fund. So I think there's avenues if you have a smaller investment you may be looking at. If you want to be kind of building wealth as you get in and tiptoe into this space, there's definitely avenues. You just have to get a little creative with it. But I don't offer directly to non-accredited investors just because of the additional work on my end to do that. Okay,
next question, and it's related to self-direction. It says, how do you avoid UBIT? And the other question related to UBTI is, in an IRA, will there be UBIT? And if so, are there opportunities to be a straight lender? So UBIT could possibly apply depending on how you're investing, how the deal is structured. Obviously, with UBIT, if you're investing in a business, then you're possibly subject to UBIT tax. If it's more so a passive investment, or again, depending how the structure of the company that you're investing with, like meaning if they're operating a business through a C Corp, then it's possible that you can kind of mitigate and avoid it. But you do want to talk with whoever you're investing with. So in this case, the investment provider, you want to consult with your CPA or tax professional, but definitely kind of talk to us at Advanta just to kind of get some more details, some information in terms of how the deal is structured. So it depends. It's possible. If you're investing in a business, an operational business, then yes, your IRA could be subject to UBIT. Conner, I don't know if you want to add anything to that in terms of how you guys typically structure deals for your clients.
No, I'm very happy you answered that question beautifully.
Okay, let's see. Next question is, and I think you answered, you went through a slide on this. It says, should the operation be in a separate LLC than the actual asset, meaning 2 LLCs? And I think you kind of outlined that, but that was a question that came up.
That's right. Yeah, I think making sure the sponsor is working with a really dedicated and focused senior living lawyer or law group. Having them spend a lot of time and trying to limit that liability to investors, and creating all those hold codes we went through. I think that's the right approach.
Okay, and I know you, I mentioned briefly about your background, and you just mentioned. Do you mind giving the audience just a kind of your expertise, because this is your area of focus with your extensive finance background. So if you want to kind of touch on that a little bit.
Just broad expertise.
I'm sorry.
Sorry, what was the question, Reneika?
Just more so relating to your background, in terms of your years of expertise, your financial background. If you can just kind of.
Oh, sure. So I was an investment banker for 10 years. I worked with several large regional providers, and then also went to a smaller shop where we really had exposure to a lot of stuff, and we had a private equity arm where we invested in properties, senior living focused properties. Did a lot of HUD work, bridge loans, sell-side advisory, mezz, preferred, kind of 142D bonds. It's kind of a high yield bond structure. It's got a ton of different transactions and a lot, different areas of the capital stack. And then I broke off on my own to start Purity Strategies fund to raise capital and invest in these, senior living properties during this cycle. Just super excited about that piece. And my company also does consulting work for some larger senior living owner operators, and helps them with deal execution and just how to process transactions and what to focus on when looking at a deal from an underwriting perspective.
Oh, wonderful. Thank you so much for that. Another question that just popped in is, can you put back up your contact information at the last slide with your contact details? Yeah, so also too, you'll get a recording of this webinar, but also too, if you reach out to me, I can email you a copy of Conner's presentation, but definitely his contact information is on the screen. Feel free to go ahead and grab it so you can reach out to him directly. With that, again, I appreciate everybody taking the time to just join us today, and for all of your questions. Conner, again, I appreciate you being our featured speaker. Great information. And if you have questions related to self-direction, again, you're always welcome to reach out to me. Definitely, I encourage you to just go to our website, advantaira.com. It's a great resource. And with that, Conner, any closing words?
No, thank you so much, Reneika. Great thoughts, and I really appreciate the time today.
You're certainly welcome. Happy investing, everyone.